Hey guys, good afternoon. This is Brian coming to you with a hopefully enlightening lesson about what's happening in the markets. I do want to kind of help build some guardrails for some of your existing strategies. This is meant to be used in confluence with whatever you're doing because it's nice to have reminders. It's nice to kind of if you have a blind spot, someone point out to you, hey, you have a car on your left, and you're like, oh, thanks. I'm not going to turn left now or merge lanes, right? So I want to, give you some guardrails to a trading car because I noticed that this price action is following basically what we experienced in March and April during the tariff what do I call it era time period. So something to note is that first off, the volatility index is incredibly high, right? I often tell people that, or our students here at Trade Algo, that where I personally have observed that I perform the best according to my trade journal, because it's worthwhile to keep a trading journal so you know what you're doing right and you know what you're doing wrong. I won't harp on that, so I want to make sure this message gets across. Is between 13 and 16. So I think, me personally, this is the sweet spot right here. When VIX is somewhere in this neighborhood, right here, or close to 16, right? Between 13 and 16, I noticed that that's just lovely, delicious. It is great. But when you start getting a volatility index of 18 all the way up to 30 and higher, that's where we start running into what I'm going to show you next. All right. Because this is all covered in the Technical Analysis Bible, which I do share with everybody. This is a document I read every single day before I open any chart. Before I start looking at the pre-market levels of SPY and Qs, I want to prime my brain on what are the rules of technical analysis. And it's pretty easy to skim through this. I'll put it in the description of this video so that you just look under the video where it says description and you can, read this along with me if you feel it's of benefit. Obviously, do what's in your best interest, but I think this would be in anybody's best interest. If I was coaching somebody I love dearly, this is something I would instruct them to do, right? Without financial advice. I should probably start all these videos off very quickly by saying none of this video is financial advice. These are observations and opinions, and you guys can use them if they work for you. Don't use them if they don't work well with your strategy. But my job is to give value to the best of my abilities. So I'm going to try to provide you with some value, starting with the VIX. All right. The VIX, once it enters the territory of 17, 18, 19, 20, and the higher it goes, there is a phenomena that does occur. All right. So number one, let's go to rule 3 of the Technical Analysis Bible. You're gonna have to start relying on bigger time frames on the charts. Why? Because the bigger the time frame on the chart, the more respected, the more reliable everything is going to be on your chart. Every indicator, every line that you draw as support or resistance, every VWAP, any indicator, really, your supply zones, your demand zones, your fair value gaps, simple moving averages, EMAs, everything is better on the daily time frame, or not better, more reliable, more respected on the daily time frame than the 4 hour time frame, right? 4 hour support is much more respected or valuable than a 1 hour support. But people trade all time frames, say, hey, it's at a 15-minute support, I'm going to long here. The smaller the time frame on the charts, the less respected, the less reliable everything is going to be, right? And when you have extreme relative strength or weakness in the market, you're going to have to combat that by using bigger time frames. All right. Because it's our job as traders, if you're participating in market as a day trader or scalper or swing trader, to understand if the market is neutral. That's where all of these rules will work best. Let me just give you a brief example so that you understand when a rule is being broken, that means we're not in a neutral market where technicals work best. So let's take, for instance, rule 2 of the Technical Analysis Bible. I'm going to use this as like a little support right here. Let's call this, I don't know, an hourly support, 1 hour support. And it says here, The more we test the support, the more likely we are to break it. So that would imply or infer that we usually, if technicals are working in a neutral market, not emotionally charged, we typically test something at least three, four, five, six times before we break. And that's usually pretty typical. Something like this: lower lows, lower highs, lower lows, lower highs, because we're in a downtrend, lower lows, lower highs, and then maybe a little bit beyond the support, but then it bounces up, and then we come back down, and then it bounces up again, maybe a smaller bounce, and that's test number one. That's test number two. And then third test. That would fall in line with this rule. Test three, four, five, or six is typically when we break. Now, what would be a violation of this rule? Boom, just breaking through and closing and then continuing going down. See how we did? We broke through and closed under uh, test number one. That would mean, okay, this rule is not working. It says here at the top of the document, if any of rules 113 are not working or being broken, go straight to rule four. You are not in a neutral market. It is either relatively strong if we're just nonsensically pushing past resistances, up, 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 and you just see green candle after green candle. It's not respecting any technicals. That's a possibility. But today, on November 13th of 2025, the market was relatively weak. Not even just relatively weak, it was extremely relatively weak. And the weaker it is, technicals are more and more invalidated, more and more adulterated, more and more closer to worthless, right? But how do you combat that? So this brings us back to using bigger time frames, because the bigger the time frame on the charts, the more respected, the more reliable things are, right? Now, I have been kind of parroting this as often as I could without being obnoxious or annoying, because I do understand that there is a dance of not saying things too much, not saying things too little, because I'm a strong believer that it's a psychology trick. The way you remember information is either a strong emotion, you remember the birth of your child way more than some movie you randomly watched on a Wednesday. You remember your wedding day way more than just visiting your friend on a random Tuesday, right? Strong emotions burn memories into your system. Sometimes your biggest losses in the market or your biggest wins will burn some sort of information into your system. Hopefully not today. We don't want to see any of you guys losing, but repetition is a way of remembering information. That's how you remember phone numbers, PIN numbers, your social security number, your credit card number, if you like to memorize them like myself. Repetition, repetition, repetition. So I try to repeat things, not too much to be overwhelming, annoying, overly repetitive, but not too little. I'm always trying to gauge, that's why I'm repeating myself in this video. Hopefully not too much, right? So VIX is high, right? What caused what caused the dump today? Well, been trying to tell the members over and over this week, like I've been saying before I went into why I repeat myself. There was a gap, folks, that formed on Sunday when the CME futures opened. And I was telling people, futures does not like leaving gaps open. And this was just a big fake out. Tuesday and Monday were like, oh, this is going higher. And I kept telling people, the more we are removed, the further away we go, the more aggressive the drop is going to be to close this gap. Now, the first gap that closed, I should have started with NQ, which is the equivalent of NASDAQ, right? The first gap that closed was NQ, right? It was a little bit closer than ES. ES is the SPY equivalent or the S&P 500 equivalent. So here was the gap. We bounced off of it, boom, in the beginning, off the top of the gap. And just to kind of bring this full circle, these rules will really, really help you guys. We actually play cues for calls just based on that top of the gap bounce. The top of a fresh gap can potentially serve as support, and that's exactly what it did before it filled it. If I zoom in, actually, yeah, I'll zoom in. Why not? You guys know that like where the gap is open. Look how we got a monstrous bounce at the top of the gap. So if you know those rules really well, you'll be so equipped to handle this market, and you'll know when not to trade also. You'll know how to trade when the rules are making sense and when not to trade because the rules are being broken. They should be the holy grail to anyone that wants to be profitable, right? And again, do what's in your best interest, not financial advice. Now, the gap did fill eventually. And what happens when gaps fill? And this is the last reference to the technical analysis Bible I'm going to make. Once a gap is closed or filled, there's a high likelihood price will reverse unless rule 4 on relative strength or weakness plays a role into whether this rule is being respected. So we attempted to bounce. See how we attempted to bounce and then we went further. Why did we go further? Shouldn't technical analysis be working? Actually, I guess the market mover said, you know what? Let's also knock out ES. Let's also just knock this one out because we're already closing gaps today. Let's close the other one. Yeah. So this gap right here, see how we bounced off the top and then went for a nice little joyride? We actually filled the gap. And guess what? Now technicals are back in play. You see how the rules of technical analysis, you'll know when not to trade because they're being broken, and you'll know when to trade because they are being working. Now 10B is actually working once the ES or S&P 500 ticker gap closed. Once the gap is closed, there's a high likelihood price will reverse, an 80+% chance. That'll let you know you're back in a neutral market. So you have to kind of understand market's too emotional. Rule 1 was violated. Market's too emotional. Rule 7 was violated, et cetera, et cetera. Hey, gap was filled, and now we're reversing. Now we can start looking for calls, longs, back in an uptrend, right? On a smaller time frame, obviously. And there is a rule on that on technical analysis. So that was the reason for the drop today. However, if VIX remains high, I want to show you guys something. This is what's happening. This is what did happen during the tariff wars. And I have a good example for you right away after explaining this to you. So let's just call this a daily support. This is a little weird on the eyes, huh? Yeah, let me make this a little bit more pleasant if I can, because those blocks are not the best to look at. All right, hopefully this works. Okay, nah, here we go. Hopefully this works. So let's call this a daily support, okay? One day, I'll actually write it out. Support. When the VIX, when the volatility index is high, Rule 13 on the Technical Analysis Bible, I kind of fibbed, I'm sorry. I will reference this one more time. The bigger the time frame you're making a trade from, because the VIX is high, we have to use high time frames. Remember, the bigger the time frames, the more respected things are. But it does come with a caveat. The bigger the time frame you're making a trade from, the wider you have to make your stop, the more room you have to give your trade. Why? The answer is here in parentheses, because that bigger the time frame, the deeper the liquidity grab, especially the higher the VIX is. So I know many of us are visual, including myself. Let's just say, let's call this daily support, and we're in a downtrend and we long support, right? Or we take a call right here. Let's call this the 100 level on XYZ stock, XYZA or whatever. We're just making a hypothetical stock, right? At the 100 level, right? Now, a liquidity grab basically goes deep beneath that daily support before it's finally respected. And on the way back up, it is a very slow grind up. You might even go back down again. And then what market movers do, they like reclaiming support in the 11th hour. And that's not a literal 11th hour. It just means at the very last second, right before the finish line. So usually if we're looking at the daily candle, somewhere around 3:30 p.m. Eastern to 3:55 p.m. Eastern, after they made you think, oh, well, data is eating up all my contracts, they'll do something like this. Do, 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 do. And the majority of the move comes after they shook you guys out because you went way below your support. And it makes sense. You're using high time frames because they're more respected, but you have to take into account the liquidity grab. So this is a strategy that I've been teaching as many people as I could. If you normally enter in with $1,000 per contract, break it up into chunks would be a wise option to consider. So getting in at the daily support, I might execute $350 to $400 here, because what if we get an instantaneous bounce? I call it an impulse bounce or an insta bounce, right? Then where is the support underneath? Maybe there's a 4-hour demand zone down here, and you'll deploy another $400 there, right? And that's your second entry. And your third is probably maybe this monthly support all the way down here, right? Let's just say the monthly support is somewhere around $90. I usually try to pick a strike price somewhere in between your initial entry that you almost kind of expect there's going to be a liquidity grab below. Why? Because again, the VIX is high volatility index 18, 19, 20, 21. You have to use bigger time frames, but also understand that you might go below them, and you have to look at the supports below the high time frames and break your trade into chunks at the appropriate places. All right. Or just treat it as a hero or zero, which is exceedingly difficult to do. So if I grab the 95 strike here at entry number one, it's going to be a little bit pricey, but it's going to be a lot cheaper when it gets down to the 95 level. Now I'm pretty much in the money, and then I'm pretty much out of the money in my last, kind of hedge of an entry, if I even get it here, where it's, maybe $200 to $300, right? This is getting a little bit messy, but I hope you're staying with me, right? This has been the best strategy moving forward. And I'm going to show you an example, because this one threw everyone for a loop, and you kind of had to understand all of these rules in conjunction together. So I did mention IWM 236 call at 2:50 p.m. All right, IWM, let me make this bigger. 236 call at 2:50 p.m. Everyone can read that, right? This was posted in the chat. But I long to support, guys, a weekly support right here. So I'm showing you the visual. Here's the weekly support right here where we bounced off beautifully. See how we just rocketed upwards? However, the VIX is high. The VIX is really, really high. Shoot, I should have done this on a different one. Apologies, folks. Give me a second. Let's go back to IWM. If this will cooperate, that'd be fantastic. And go back to the hourly time frame so you guys can see it better. And you can see that the high time frame was respected, wasn't it? The high time frame was respected, because the bigger the time frame, the more respected, the more reliable things are, right? Rule 3, especially with the high VIX. The bigger the time frame, the more respected, the more reliable things are. These rules go in conjunction with each other. Choppy, low volume, high volatility environments weaken the time frame you're looking at substantially. In high volatility environments, it's highly recommended to increase the time frame. However, you can't just long daily time frames just for the sake of longing them. You have to keep Rule 13 in your mind at all times. The bigger the time frame, the wider you have to make your stop. Why? Because the deeper the liquidity grab below support, before support is possibly respected. So here's the the weekly sloping trend line, and we rocketed upwards. We liquidity grabbed deep before it was finally respected. On the option, this is a very, very difficult hold. It is not an easy hold at all. In fact, I think I mentioned to the members what my average was. My average on IWM is $82 per contract. I normally do not give entries for trade ideas or high risk trades, only the official trades, because those are the safest with the highest confluence possible. It's all covered in this guidelines document. And again, I told everyone, we're back to the tariff strategy, the high volatility environment, back to our strategy in April and May, right? Now, $82 per contract. Look what happened to this contract when it was liquidity grabbing lower. Down 10%, down 20%, down 30%, down 40%, down 50%, down all the way to 60%. And then, guess what? After the liquidity grab was over, zoomed on higher all the way to 70% gain. But those are very difficult swings to hold through unless you're mentally prepared from the very, very beginning to understand how the market movers operate in a high volatility environment. Let me actually do this and show you how shiesty they are. Remember the whiteboard, how I showed you guys this, how long support, and then they kind of make you, they kind of dance around under the support, and then they actually make the move in the 11th hour. No different here. Really no difference here. If you entered at support, they want to make you think this thing is going lower. Boom, out for a little gain, boom, lower, I'm back to break even, and boom. And most people get out here because they look at their P&L, their profit and loss, and then they cannot stick it out until the market closes. In the 11th hour, the big move comes. I hope this all makes sense. You might have to watch this video more than once. I tried to make it as concise and succinct as possible, but it's something to put on your radar. So let's recap. High volatility environments, increase the time frame. Why? Because the bigger the time frame, I'm going to put a picture of a little clock. Increase the time frame. However, what happens with increased time frame? I'm going to put increase here. I'm just going to write it out. Liquidity grabs below the time frames. Liquidity grab, especially if you're using a monthly support, right? Now, liquidity grab below the time frame, break trade into chunks. And if you break your trade into chunks and then play trades appropriately, something like this, here's your daily support, boom, boom, boom. Here's the next support, boom, it's liquidity grabbing below the daily support. And then boom, on your way back, it'll dance around until the 11th hour where you make all of it back. You make all of it back, and you fully anticipate this because guess what? The volatility index is high. You're increasing the time frame, expect a liquidity grab. With liquidity grabs below your initial reliable support, you're going to have to break your trade into chunks and then look at where the next reliable high time frame supports are. I hope this makes sense because this was the strategy that I kind of had to adjust on the fly in March and April earlier this year when Trump was going back and forth and tariffing everybody, and the market did something extraordinarily similar. It could seep into tomorrow, so this is something to keep on your radar. And it's actually a good rule of thumb. Look at the VIX first thing in the morning, check it a couple times a day, and see if you have to use something like this and adjust your strategy if necessary. Now, if you guys have questions or concerns, as always, you guys can reach me at brian@tradealgo.com. If you need some clarification, if there's an ambiguous statement you'd like me to make a little bit more unequivocal, meaning have less meanings and hopefully make it clear, anything like that along those lines, I'm happy to help. Like I said, it's a lot of information, but it's all here in the Technical Analysis Bible. I created it. And notice how it doesn't say Brian's Technical Analysis Bible. I'm at the mercy of these rules as much as anybody else. It is just the Technical Analysis Bible. It deserves its own respect. I have no claim over it at all. They're just rules I have observed that have withstood the test of time in all markets. Crypto, futures, stocks, options, everything. It works in different environments, whether it's tariff wars, whether there is no tariff wars. Whether it's high inflation or bad CPI report, this document I will post again in the description of the video. I hope this helps. Let me know if I can serve you guys in some way. I hope this was enlightening, and hopefully you guys can use this to your advantage. And happy trading, everybody. Have a wonderful and blessed day, and I'll see you guys, as always, in the next one. Everyone take care.